Hello, everyone. We would like to start by thanking Rotman Net Impact, Leasing Institute, and RBC for giving us this opportunity. We're going to present our Net Zero to 2032 portfolio. Our team is the Impact team, and it is formed by Mehpred Kaur, Marcela Castillo, Andres Rodriguez, and Rafael Rodriguez. So we want to start with a brief summary of our 4 stages to develop our proposal. First, background, summarizing the net zero target and the current client portfolio. Second, our approach for sustainability, ratings, carbon emissions, and mission ambition for 2032. Third, how we build the portfolio, the risk, geography, and portfolio themes. And finally, the portfolio proposes, its carbon emissions target, offsets, and possible risk and mitigations. So let's check the COP26 targets. First, their ambitions emission reduction by 2030 and securing net zero by 2050. Second, mobilize finance with financial institutions ensuring that public and private sectors achieve the net zero goal. Third, protect and restore ecosystems. And finally, work together to accelerate action to tackle the climate crisis. So all of these apply, how all of these apply under a sustainable finance perspective? By 3 core things. First, increase sustainable investment standards. Second, manage sustainability related risks for the financial industry. Third, enable the shift of investments from unsustainable to sustainable economic activities in investment portfolios. And with all of this background in mind, we would like to proceed to analyze the current portfolio of the customer Canadian University. And we found the following performance metric: a carbon intensity of 131,284 tons of carbon emissions per year, a Sharpe ratio of 0.51, and standard deviation of returns of 8.35%, and a return before taxes of 5.34%. Furthermore, we found more indicators of the current portfolio: a geographic breakdown of 63% on Canadian, 19% on the United States, and 20% in other regions. And the principal industries breakdown are 29% government, 19% in financial services, and 9% in industrial and energy industries.
With this background, we're going to present the approach we're taking for a sustainable portfolio. First, the MSCI ESG fund rating, the weighted average carbon intensity, and the mission and vision for companies to 2032. Our first approach is the ESG fund rating, which is a metric that compares different companies based on the exposure to industry material ESG risk and their ability to manage this risk. And it's in a scale from CCC to AAA. Our team decide to focus on those who are minimum of AA in the ESG rating. That means we are going to search for ESG stocks, funds, and projects from companies that are leading in their industries in managing the most significant ESG risk and opportunities. Our second approach is a weighted average carbon intensity. This metric indicates a portfolio exposure to potential climate change related risk relative to other portfolios. We decided to search in stocks, funds, and projects with the lowest tons of carbon dioxide emission, and we only consider those that are equal or less than 134.6 tons of carbon dioxide per $1 million sales. And we choose this number because it's the weighted average of North America. Our third approach is the mission and vision the companies have for the following years. We know that the net zero target is very ambitious, but that's why we're going to focus on our research on companies that have already established their mission and vision through this target. And as we can see in this graph, we plan to, in the following years, reduce linearly to reach our net zero goal. So with that, we can present how are we going to build our net zero 2032 portfolio. First, we're looking for broader diversification across risk factors, geographies, industry, and asset classes. Second, the emissions, we're looking for securities with a low carbon emission, with a low carbon intensity, and also we're looking for carbon offsets to reach this net zero target. And about risk, we focus on the target return of 6.5% with a minimum volatility and 6% of portfolio allocated to active investment in Canada. And we are looking also for companies screened based on the ESG rating, the weighted average carbon intensity, and their mission and vision for the following 10 years. Now, Andres is going to present our proposal.
Thank you, Marcela. So with that methodology that we're implementing in mind, we are presenting here the proposed portfolio for the client. So basically, as mentioned before, we had this target return of 6.5%, and we estimated what would be the best portfolio within the investment space of Canadian and global stocks and bonds. And we minimized the standard deviation of returns based on that. And results shows that we should invest 34% of the portfolio in fixed income, 54% in Canadian, US, and global equities, 6% in Canadian stocks, which is going to be an active play, and 6% in alternative investments. Overall, our portfolio is expected to have a carbon intensity of around 100,000 CO2 emissions per year, which compares favorably to the existing client's portfolio, which has 130,000 tons of CO2 emissions per year. Next, we are doing a back test of the portfolio. So from January 2021 to February 2022, we estimated how our portfolio would behave and how the old portfolio of the client would behave. And as you can see in the left chart, if you invested 100K in January 2021, you would end up with around 110K with our proposal, which is equivalent to a yield of around 8.5% and a standard deviation of 6.1%. Although the old portfolio has higher return, it also has a higher standard deviation. And we overall consider that our portfolio is fair in terms of risk and return. In the next slide, we are doing the factor regressions to understand whether the strategy of our portfolio is different from that of the old portfolio. And if you can go and see the highlighted numbers are those that are statistically significant. So we're going to start only with market risk. Market risk exposure is relatively similar across both our proposal and existing clients' portfolio. Then we have a small caps. So only our portfolio has a statistically significant small cap exposure, and that's going to enhance returns. And finally, we have value. Both portfolios have value play. So overall, we're adding small caps to our portfolio, and having a diversification across risk factor is expected to yield a more stable return over time, as risk factors are negatively correlated. So on the next slide, we're presenting how we build our portfolio and some measures in terms of its geographic diversification. So most of it is concentrated in Canada, around 79%, and the rest is in the United States and other regions. In terms of industries, most of it is in the government, in the Canadian government. This is because of the fixed income part of the portfolio that is mostly invested in Canadian government, and the rest is less than 21% of the portfolio. So overall, across industries, we are relatively diversified. And in the next slide, we're doing a zoom into the fixed income. So the fixed income part of the portfolio accounts for around half of the emissions, and it is comprised of a diversified set of securities that were screened against ESG standards as per Bloomberg's MSCI Canadian Aggregate ESG Focus Index. that guarantees that our portfolios will, like our securities will have a low carbon intensity. And we are also, presenting some characteristics of this fixed income portfolio. So overall, we have a yield to maturity of 2.2%, which is quite attractive. And this is done by having a moderate duration of around 7.9 years. And overall, our portfolio is very well diversified across 430 holdings with credit ratings mostly in AAA and AA. So overall, that's the fixed income portfolio. And moving next, we are doing a zoom on the stock portfolio. Here, we also selected a group of stocks that were screened against ESG standards across Canada, the US, and the world. And these stocks are very well diversified across issuer, industry, geography, and market cap. And as I mentioned before, there is some tilt towards value and small caps. And the expected emissions of this part of the portfolio is 49,792 of the scope 1 and scope 2 emissions, which is almost half of the total emissions of the whole portfolio that we're proposing. Similar, we are presenting some big numbers in terms of the portfolio characteristics. So price to earnings of 20, price to book of 2.6, and over 2,200 holdings for this part. Next, I would like to pass it over to Krudat for the next part of active investments.
Thank you, Andres. So moving on to active investments, we made a conscious decision to 100% invest in Canadian equities. So all the stocks that you see, we invested in 6 stocks and they were all invested in Canadian equities. Secondly, we had 100% renewable energy. So all the stocks use renewable energy resources like solar and wind power for power generation. So they either build, develop, or operate these resources. Then carbon intensity, as we've spoken about the MSCI index, all the securities that we have selected adhere to this. Also, we believe that Canada has a great support and commitment for energy innovation, and coupled with the low R&D costs and skilled workforce that we have, we think that all these stocks have great potential in the future. Moving on to the alternate investments, we invested in a real estate investment trust called Vernado Realty. They primarily build offices and high street retail properties in the United States. They have a goal of reaching net zero by 2030 by applying strategies to reduce the emissions from the buildings. You can see on the left that they have really strong financials with a market cap of 9 billion and the current year growth estimate of 15.1%. On the right, we see that they have great ESG and sustainability targets as well. So they aim to have 55% energy reduction of landlord controlled energy by 2030 and 45% reduction of tenant controlled energy by 2030. And they've also already seen a lot of progress by 2019. They're also working towards reduction of waste with 83 tons of waste already being reduced. So we can see that this company is really invested in sustainability, and even financially they're doing well. So that's why we made the choice. Moving on, so we had an offset strategy. We realized that the net zero target for 2032 is ambitious. So we decided to have carbon offsets in our portfolio. Carbon offsets are certified by the gold standard. They assure that we have our investments that will lead to positive impacts for the climate, the environment, and the communities. And these are real and verified and not just symbolic. So for the carbon offsets, we had a cost between 32 and 50. And for our portfolio, we took it as 50 per ton of carbon footprint that was created by the investments in our portfolio. Moving on to how our portfolio did, we had expected gross returns of 8.1%. And after the reduction from the carbon offsets and the management fees, our return before taxes is 6.58%. We also analyzed some risks and mitigations for our portfolio. On the x-axis, we have the probability, and on the y-axis, we have the severity. Starting with the COVID-19 outbreak, this has affected most companies in the past, and we think that with the new variants being less severe, the probability is lower, but if it happens, the effects will be severe. The second one is the increase in carbon offset prices. So we think that there's enough flexibility to balance the portfolio, and the probability of this happening, even though it's high and the severity can also be higher. Increase in carbon dioxide from portfolio companies, we think that there is a high chance of this happening, and the severity will also be extremely high for this. Interest rate risk that we're seeing all around the world, interest rates are increasing. So there is a high probability of this, with the severity being really major for our portfolio. Geopolitics, we do not think that, we think it's highly unlikely that major world superpowers will have any kind of confrontation, but if it happens, it could adversely affect us. Regulatory risk in renewable energy. So developed nations are currently committed to continuing fostering renewable energy of regulatory incentives. So for this particular measure, we thought that the severity could be high, but the probability was not so much. And this brings us to the end of the presentation, and we thank you for your time.